Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Owen Rask, welcome to another episode of the Australian Investors Podcast.
Hi, Drew. Meredith, I've got a question for you, mate, as we start off today's show.
I know where you're going with it.
Would you rather be YouTube famous or TikTok famous?
TikTok for sure.
Well,
TikTok.
I don't know why you're trying so hard to be YouTube famous.
More of the zeitgeist at the moment.
Zeitgeist. How long does it take to get into the show to talk about the zeitgeist? I brought it up in another interview today. You'd be proud.
With Jonathan?
No, it was with Doug.
Doug. Any more than Doug?
No, Doug Morris from ShareSite CEO. Great guy.
Nice. All right.
So you just published this video on your YouTube channel over at Waddle Partners. The best way to access your super after you retire. I haven't actually watched it. Don't worry about that. But then I'm just reading some of the comments. What about access for early retirement? Yeah, boy.
It's a good source.
Run out of super and savings. Pension helps? ?
I spent about 40 minutes getting rid of all the crypto spam that was in the comments too.
Retirement years equals live off the FKN pension. Bitcoin is my retirement.
We have had feedback about at our own jokes too often as well. So I'm going to do my best not to. So.
Oh yeah, we got some heckling through the comments this week. I feel like the Waddle Partners saloon has just opened on the Wild West streets of YouTube, and you and Jamie have just like invited everyone in. Hey, come in here, guys! And all the cowboys have rocked in with like, Bitcoin is my retirement plan.
I mean, it is one of the challenges of being in financial services, isn't it? Literally, as soon as we put this video up, it went into this spiral of 27 comments directing you to some person, I'm not going to say their name, who traded in crypto.
Yeah.
Like I can imagine how easy it is to just get lost and be giving your money to someone in another part of the world pretty quickly.
I see, like, when I go into, I shouldn't say this, but I will. When I go into like our YouTube app, because we've got like a creators app thing, I reckon like 80% of the comments, I'm just like, report spam, report spam, report spam, report spam.
All engagement's good engagement. That's what you told me.
I don't know if I told you that, but you do get that. Like it's just like, I feel like there's some bot farms out there on YouTube that are just like, they get like 30 people's, they hack like 30 people's, Gmail accounts or YouTube accounts, and like just create this like vortex of like
Bitcoin.
Mr. Benny helped me trade my Bitcoin $5,000 sign a week, and you're like, oh gosh. Anyway, we could laugh and have fun, but if you haven't already checked out the Waddle Partners YouTube channel, you should know it's going off. #retirement planning is what it's got there. So check that out. Today we've got a bunch of questions, a little bit of heckling, not too much, which is good because we're all civilized people. Drew, what have you been working on this week?
I saw something really interesting. We just filmed Waddle's monthly update, which will probably go out to clients next week and open to the public as well.
The saloon doors are open.
Did you? We were talking about. Do you think Elon Musk has the potential to be president at some point in the next 20 years?
He's not a US. He's not born.
That's what I said. Was he born in the US? And I'm sure Trump could change that if he wanted to. But what I found quite, and I assume this is on purpose, that the department that he's going to be helping is called the Department of Government Efficiency.
Yeah.
What is an acronym of that?
Oh wow.
DOGE.
Dogecoin. It lives again. Dogecoin is an Australian invention.
No, Trump's very, he's always been good with the media, and if clearly this is on purpose, it's incredibly witty. Surely.
Hey, does Trump drive a Tesla? You reckon?
No chance.
Yeah.
You can't have Maccas. Not yet. I do not. But me and Jamie, my business partner, were talking about it today. And I don't think we looked that closely at novated leases for a while, but the ability to have no fringe benefits tax on pre-tax money for an EV, it's like it almost becomes a no-brainer.
It is a no-brainer.
His advice is buy 2 cars. Not financial advice.
But seriously, yeah, if you haven't already looked at novated leasing, or if you own your own business, just in general, you can look at electric vehicles under the luxury car tax threshold. It's easily one of the biggest, not a tax loopholes in the country.
Not a rot.
No. So, but it's a good incentive because you get, rather than put it on the government's balance sheet, get business owners and people in corporate jobs where they can do novated leasing to go and decarbonize the economy one car at a time.
Yeah.
Let's get them to buy EVs, and then it forces the manufacturers to do something about it. So I think it's a great move, and I think why not? Yeah, that's good to know. So I'll see a number plate with Deremuth driving down the street soon. It depends. You actually go on.
No, I just put Doge on there.
Oh, Doge. I did actually see in your notes for this week that you shared this table of the top contributors and detractors to the ASX. Real quick though, you might already know this off the top of your head. What has the ASX returned over the last 12 months?
Year to date?
Last 12 months.
From January to today?
Last 12 months.
From January to today, it's 10%.
Well, last 12 months, it's 20.
Really?
Yeah, pretty sure. 10%
in December last year.
Let me bring
that
this
would
up.
make sense.
Let me just bring this up. So, anyone that's watching.
I was doing the numbers on year to date, not 1 year. And then if you look at year to date, so
look at that.
19.93
without dividends.
Yeah.
Yeah.
We were
and then
year to date this morning, and that's 10% year to date.
And
Also, this is bang on the long-term average of Australian share returns, or maybe global shares in general returns. Australian's been a bit lower than that.
Over 12 months, though, you're talking about. What about you reckon the S&P 500? What's that done? We'll just go the IVV ETF, which is US dollars.
I was talking about these on the monthly recording this morning. So
okay, well, you should know that.
December. So I know that, from January 1, both the NASDAQ and the S&P did 26. So I'm going to say for 12 months, the NASDAQ's done 35 and the S&P's done 32. That's a guess.
33 for the S&P 500 ETF.
Close.
NASDAQ should have probably done a little bit more. 29, 30. So it's done a little bit less. So S&P 500, the 500 top US stocks. But it's really interesting because I was talking to Kate about this morning for the finance podcast. If you walked onto someone in the street, you're like, hey, so here's the thing. Last 12 months, ASX, Aussie shares up 20%, not including dividends. Chuck those bad boys on there. US stock market, 33%, not including dividends. Gold, 30%. Bitcoin, a lot. Cash, paying a lot. Bonds, flattish to up, total returns. If you said that stuff to everyone, they'd be like, oh, yeah, but the economy's pretty bad.
Yeah. I mean, one message reiterates the importance of investing globally, doesn't it? Like 10% in Australia, 26%, or 20 in Australia, but over 2024, it's only 10%. And there's still a big buffer and higher growth and better returns are coming from overseas.
I think I have this kind of bullish take that could actually change a bit. I think Australia over the next 10 years could be quite interesting. I think we could be primed. I think if we foster a little bit more, if we give a little bit more incentive for particularly technology and industrial companies to list on the ASX, I think it's actually a pretty good time because if you look at a lot of the technology companies, which we might talk about in a sec, a lot of them have really high multiples. Like their valuations are incredibly high. And that's really promising for companies that want to come and list. Like say GYG recently, with its listing was super well received. So I feel like there's a lot of opportunity for people and for business owners to list on the ASX and to kind of transform our market. Like we've seen ResMed, WiseTech, Altium got bought out, Pro Medicus, Cochlear, Nanosonics, like all these technology companies over the last 5 to 10 years have just absolutely dominated the market in terms of the returns. Xero, these types of businesses.
And they trade on high multiples because there's less growth available here. So
that's it. People want them.
To pay up for it.
Yeah, and so that's good for the companies, right? That's good for their listing potential. But if we look at the top, this is from the data that you shared. The ASX is
2024.
For 2024, the ASX's top contributors. We can see CBA. Obviously, it's the biggest or second biggest company. Westpac, NAB, blah 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 blah. But in that list was Xero, WiseTech, ResMed, and the Honourable Pro Medicus, all in like the top 15.
So the market gained 800 or close to 1,000 points for the year. 440 of those points came from CBA and Westpac alone. If you add the other two banks, I think it's like 600 of those points. And obviously, you got to offset the losses that came from resources and mining. But I thought that was kind of a standout as well. That Pro Medicus added 23 points on its own. So if you think the ASX at 8,000, that took it to 8,024. And WiseTech and Xero, as you said, like these Australian technology companies having an influence on the market.
What's interesting is Pro Medicus added 23 points, ResMed 23 points, WiseTech 28 points, right? But that's the equivalent of what Woolworths, Woodside, and Rio took off the market. Yeah. So those are much larger businesses, and it shows you that this is the beautiful thing about index investing is like those businesses start small in the index, but then over time those winners, really outweigh the losers, and that's why an index fund goes up over time. And the better companies slowly rise to the top. They kind of bubble their way to the top until they eventually become the next CBA, the next whatever. So that's quite interesting. Macquarie is also a big contributor to the market. A big detractor was Fortescue, and BHP took 130 points off BHP. Naughty BHP.
All alone.
Yeah, by itself. And why is that, Drew?
I mean, it's basically if you looked at over the last 5 years, I'd suggest BHP, Fortescue, and Rio Tinto were the biggest contributors to the market and to growth that was in the market. So you've seen a passing of the baton from resources and mining, as we've seen the mining, not the mining boom, but the iron ore boom has slowed. Chinese growth slowed, and they're the biggest incremental buyer of commodities. So that's been the biggest impact. And it just shows. I think there was a comment in here about we're recording the market, but the market can be as narrow as 2 or 3 companies. And even if the ASX 200 has 200 companies in it, there's 3 here that have had an outsized impact on returns.
I'd be interested to see the same contribution versus detractors report on the S&P 500 or the NASDAQ 100. Obviously, everyone knows that FANG stocks are going off the charts.
Yeah.
For a variety of reasons.
I reckon I can track that down.
Really?
Give me a job for next week for sure.
Okay, interesting.
I think it's easy to track down for the S&P.
It's a lot more data in the US. Yeah. But it's quite interesting because it just, once again, people would see this and interpret it. Like 5 people would see this and interpret it 6 different ways, which is that, CBA adding nearly half of the ASX's contributions. That's because it's done well and it's massive. It's the biggest company. So it makes sense that it would have such an outsized impact. Would you buy CBA?
Yep. Still comfortable.
Okay.
I mean, if you're buying an index fund today, you're buying 9-10% of CBA. Anyway, so you have to have some level of confidence around the banking sector.
I spoke to Brian Hartzer last week, former Westpac CEO.
He's a seller?
He's a what?
Is he a seller?
Yeah, he was very bearish. No, I'm kidding. No, I'm kidding. No, he was really interesting. He was really kind of like honest in it. Like we didn't have a lot of time saying that the podcast went for like an hour and 40 minutes.
The longest in history.
Something like that. It was
longer than Joe Rogan.
We had a good old chat. But there were a lot of things that I wanted to get to with him. We just didn't end up having time. But he did say to me that a lot of the other banks just really dropped the ball on a lot of really golden opportunities with technology and things like that. Like you'll be very pleased to know that Brian oversaw the investment from Westpac into Zip.
Oh, beautiful. Well done.
Yeah. So, but I think he did get out before.
Surprised he didn't have me as a guest interviewer so he could connect on our investment into Zip.
Well, I was going to ask him for financial advice from my mate who's a struggling financial planner who's really down on his luck with his stocks. But I think they did a lot of work with it early on and then got out, which is obviously good for them. But what's Zip up these days? Whoa, 800% in 1 year, Drew.
Beautiful. That's what Zip's still below purchase price.
But it's on its way back. Is what the consensus.
Another good example of those not falling knives. I invested in a company called LiveHire some time ago in the IPO.
That rings a bell. Is that LVT?
LVH. It's another story of when you have to make a call on some companies and get rid of them. I mean, that's always a bad sign when there's such big block trading like that. It means there's no volume at all. What's the volume today? But this is one that listed at 20 cents, trade up as much as like 60, 80 cents at some point, I'm guessing. 40. All right, I'll take 40. 45. Give me 40.
Oh, no, $1.50.
I did get $1.50. Yeah, floated at 20. And then you have this anchoring bias, and eventually it's got to take over offer at 4.5 cents.
You know what we should do in 2025 is we should, with the support of everyone that listens to the show, we should all come together and you create a portfolio with $10,000 in it. I create a portfolio with $10,000 in it. And we just
watch it for the year. Let's do it.
We just do stupid ideas. Like we just do like the most outrageous ideas that like this thing. Like what is it? What does this even do? So it's got 1,000 employees.
I mean, this is like
that was 2016. There's what, sorry?
Like pre-employment hero. So it's like like reviewing CVs from memory and that sort of thing. That was a selling pitch in the IPO that I got some time ago. I should have taken the profit when I had it. But I mean, this for me is that story of when a stock falls from $1.50 to 4 cents or 3 cents. Not that I bought it recently. I was still anchored to the 20 cents I paid for it. But for something like 5 years, I've actually bottom drawed it. And now you get taken out. And this could be the problem with some of those larger companies we talk about as well. They get taken out at a much lower value and you never get the opportunity to recoup that money. And that's why a lot of these decisions is there's an opportunity cost. And I could have invested in, I don't even have to say NVIDIA, I could have invested in CBA or any other range of companies that didn't do minus 75, that had more upside, even more in dividends that I ended up getting out of this for the last 2 years.
Yeah, it's quite interesting. I must admit, there is something about when a stock price starts to go like horizontal with like, it's like, this is a 1 year chart that anyone's looking at on YouTube. But if you're listening, we're looking at a 1 year share price chart and it's like square blocks everywhere instead of like a jagged.
Which tells you sometimes it just doesn't trade.
And true. And it shows you that like, it's like 1 cent.
Jagged on a 5 day would be okay. It just means, the price stayed the same for a couple of days. But on a year, that's probably increasingly.
On a 5 day, it looks just like a straight line. This thing is flatlined.
Hey, it's green.
Well, it says here in the Google summary that the company used to have 1,000 employees. Now it's 18 mil market cap. Like if this was NVIDIA, it'd be like, it'd have $100 trillion of revenue.
Yeah.
Anyway, I mean, that's a trip down memory lane, Drew.
we do that quite a lot, unfortunately.
So
winners in my portfolio. Let's talk about them next.
Okay. So maybe what we can do then is if everyone likes the idea, let us know right in via the link that says ask a question. Maybe we can have $10,000 and we'll track it with one of the friends of the show's tools that they use. And we'll make it publicly available and we'll just pick 10 things. Well, we won't say how many things. We'll just pick a portfolio and you can allocate the 10 any way you want.
All right.
And we'll put the episode out on, like, we'll pre-record it, put it out on January 1st. And we'll see.
General advice only, of course.
Oh, of course. It's not an actual real portfolio. It's like, let's go with like a theme. Like we have to like name the portfolio and everyone can contribute ideas. And you got to say if it's Team Owen or Team Drew. I'm all for like speckies. So send us.
I'm all against speckies, but I'll find a way to get them into this one.
Well, I don't like speckies as a professional discourse, but just for the show's purpose, please write in and give us some suggestions. Speaking of, someone did write in here, Drew. Maybe we should talk briefly about this because it's kind of specky related. And by the way, if we do answer your questions on the show, anything that you hear, listen, see, whatever.
Would someone win 2 books this?
Yeah.
Both the questions were from the same person. That was amazing.
Yeah, so they're really committed. But
listens or no?
Hopefully they don't hit download twice. But if we do answer your questions on the show, we do not know your needs, goals, or objectives. So any of the information that we deliver is strictly general in nature. If you want personalized financial advice, for example, retirement, investing, estate planning, insurance, speak to a financial advisor. You can find a link in your podcast player that will direct you to get financial planning. You can get matched via our platform. Or if you don't go through us, just go through moneysmart.gov.au to verify the financial advisor that you're working with. They have to operate under Australian Financial Services License. Pardon me. If we do mention things like ETFs or super funds or things like that, they will have a product disclosure statement. It is really important that you consider and you read the PDS before investing. Slow Steady writes in, not slow and steady, just Slow Steady, writes in and says, I own Revasum RVS semiconductor back in 2021 in the ComSec app. But recently, it's not in my ComSec app. I checked in ASX website and it says it's been delisted from ASX exchange due to failure to pay the listing fee. End quote, I guess. Now, will I lose all my shares? ? Or what do I need to do next? ? Drew, over to you.
Always give me the fantastic questions. I'm trying to go on. So there is a website called delisted.com.au.
Yep, I'll bring it up.
You can bring that up on. Yeah, that'd be beautiful. And this is a history. So even things that were demerged or demutualized, all these sort of things can come up through, and they help track things down. They can also help you sell illiquid shares or shares that have gone bankrupt back to them for next to nothing. Essentially, there's multiple reasons why you wouldn't pay your listing fees, and in a lot of cases, it's because the company's gone into administration. I'm just trying to read through and see if this was the case. But generally, if it was just not listed anymore, they'd have to go through a vote and take the company off the ASX, and then you'd have shares in a private company and give you the opportunity to sell them at some point. In this case, it looks like the company has gone into unable to lodge its financial report. The ASX has suspended trading, suggesting it probably trading looking at liquidation or administration, and that shareholders in this company could consider crystallizing a capital loss in 2024, 2025. So it sounds like it hasn't it's voluntarily not paid ASX listing fees for one reason or another, if that makes sense, versus forgetting to pay your ASX listing fees. Doesn't happen very often. But I'd suggest here you would still have shares in that unlisted company. Delisted is one way, and this is not a recommendation, but delisted is one resource that you can look at to find out what to do with it. But in some cases, you'd have shares that would then be in a private company that you have to deal with the company directly to find out what to do with them.
So what delisted does is they also give you an option to sell the shares. I think they must make money from, I don't know, something or other, but maybe just give them a call and speak to them if that's something that may be of interest to you. But yeah, this is pretty common, Drew. You do get a lot of companies go from public to private. So they go from the stock market to not being on the stock market. You obviously don't want to be in this situation because it just adds a lot of pain, as you said.
Yeah, exactly.
A lot of admin, forces you to sell if you don't want to sell in certain instances. But it's, to be honest, it's just one of those things where if you buy a speculative company, I think you need to be on top of it. Ultimately, the key to investing in individual companies, in my opinion, is the more risky it is, the more speculative, the more you have to be hands-on. And if you know what you're doing, then small caps and micro caps are an absolutely wonderful place to invest. If I wasn't investing on behalf of the whole Rask community, that's where I would spend a lot of my life. Probably more so in private companies, but also in public companies. Because I think that there's a lot of value to be added, particularly on the ASX microcaps there. But it's like a full-time thing. And if you don't have the ability to be really your finger on the pulse, so to speak, I think that you've just got to really limit your exposure to these types of positions. So when I said speculative before, Drew, with my $10,000 hypothetical portfolio, I'm not talking about this type of thing. I'm talking about like tech stocks that are like established, right?
Exactly.
That we could. Like when I say speculative, I just mean like they're in the family in the satellite camp. So
on valuation, not running out of money.
Yeah, exactly.
Much debt, exactly.
Now, in terms of this person, I think just generally, just go and head to delisted.com.au is the website. It's not a recommendation, but they will have information on what could potentially happen. There are instances where some companies go off the exchange and do way better. There was one particular company that did video gaming and blockchain technology a few years ago. It went from the ASX to Primary Markets, Drew, if you know that platform.
Yeah.
So it's a private company.
Listed private company.
Yeah, it's owned by a listed company. So a bit confusing, but When a company is listed, all it means is that you can buy and sell its shares on an established stock exchange. There is the public market, private markets rather, where you can't do that. And that's the whole point of them being private markets, is the companies aren't big enough or they just don't want the public listing. In which case, you can still buy and sell shares. Like if you're an employee or something like that, the company typically can do that themselves. The key thing is just knowing how to do it. And there's typically, if you visit the company's website, they might have information on that.
I think
All
it's one of the interesting things here is that, from time to time, when you're investing in these companies, they can go bankrupt or go into administration. And it actually isn't as straightforward as you think in getting a capital loss from them. That in some cases, because the company's going through this process still, you can't realize that loss. You can't use that to offset other gains you've made. So groups like Delisted can offer the opportunity to sell off those holdings, crystallize that loss, and claim it. Because liquidation and administration go on for 2 or 3 years in some cases.
Yeah, it's just an administrative pain in the backside. Rask 182, which is the question that we wanted to get to last week, but we didn't. Rask 182 runs in and says, looking into listed investment trusts, what would your preference be out of all these different things? GCI, KKC, MOT, MRE, MXT, PCI, or QRI?
Financial advice.
Any general advice on what the pitfalls I should look for would be greatly appreciated. So let's just talk about that pitfalls section, Drew.
Yeah.
Let's talk about the pitfalls of investing in listed investment trusts. Maybe you can just explain what a listed investment trust is to begin with.
A listed investment trust is a closed-end vehicle, much the same way as a listed investment company, just a unit trust, which means new units aren't issued regularly. And what they weren't particularly popular, I think, because listed investment companies were popular for a long period of time because they were able to pay a placement fee from memory. And this is where listed investment trusts came in as well. They were able to pay a placement fee to stockbrokers, financial advisors, or generally just the distributors. And these became quite popular for a while, but then disappeared quite quickly. But it's similar to a managed fund or an ETF, exchange-traded fund. The difference being that new units aren't created regularly. So it has an existing pool of assets, essentially a guaranteed pool of assets that can't be added to or can only be added to in very limited circumstances, which means it, like a listed investment company, it carries a net tangible asset value, and the unit price can trade very differently, or the share price can trade very differently to that net tangible asset value.
And the reason that happens is because the reason that these are interesting for the fund managers is that it's very similar to, like you said, like a listing. Yeah, and they can do things which maybe they wouldn't otherwise be able to. So, for example, in the case of the MXT or the Metrics Master Income Trust, Metrics is a private debt investor and has a lot of experience. We've done some interviews with them over time, but it says the Metrics Master Income Trust provides investors with the advantage of direct exposure to the Australian corporate loan market, a space dominated by the regulated banks. And so you can get exposure to these different asset classes via a listed investment trust. The other one, which people may be familiar with from being on the Rask network, and we get a lot of questions about it, is ASX QRI, Qualitas Real Estate Income Fund. In a similar vein, this fund effectively pays monthly distributions, if I'm not mistaken. And what they do is they take the money that's in the fund. Let's just don't take that literally because there's a little bit more that goes into this. But basically, they take that money and they lend it to real estate developers, real estate projects, that sort of stuff, for like quite short-term loans of like, say, 9 to 15 months, something like that. And they get a good income return from that. And that's just part of this whole private credit part of the world. And they've been I would say they've been pretty successful, Drew. I don't know about you. Some of these strategies have been pretty successful.
I mean, you can have different views on the future and risk and all that sort of thing, and all these things are always about buyer beware. But Qualitas and Metrics are like incredible stories of non-bank lenders growing from it very little to being these significant parts of the economy.
Yeah,
the size that they've done and the amount of lending they do now is exceptional. It is interesting that I think it's mainly credit that's gone into the listed investment trusts, because I think that's when the legislation turned, whereas most listed investment companies were always in fully franked shares. I assume it's because it's a trust, not a company. You're getting flow through of income rather than franking credits. But this locked up capital, the benefit and what they'll talk about is you're able to access these private markets, and because your capital, the capital that they've got is locked, it allows them to be patient and be more patient investors, and it kind of forces the shareholders to be more patient as well, or you'd hope it does. But you can see movements around that NTA pricing. And the one thing, we're not commenting on any of these specifically, is that any time you're investing into a private market investment, that the benefit of private markets are not valued as often, they're less volatile via a listed or a liquid structure. It always opens the potential for risk there. That if there's a significant repricing in private, what happens on the public market, and you'll see during crises these things react incredibly quickly, but the underlying assets don't necessarily change.
Yeah, there's actually a good chart on that. We can bring up the metrics.
It's always knowing what you own.
Yeah, a similar thing, to be honest, should have happened with like some of the hybrid funds, ETFs, even during COVID. Like we saw a big departure. This is going to be a bit geeky for some people, but we saw a big departure from the net tangible assets inside of these ETFs into the share price. There was what we call a buy-sell spread. There was a significant deviation, because anytime you take money that's in a stockbroking account and you invest it into something that goes into an illiquid asset class, like a private credit,
this could be anything,
bonds, like
private equity.
Private equity, there's going to be, if you're investing at a time of uncertainty, like real uncertainty, like during COVID, there's potential that you're either way underpaying or way overpaying for the same asset. And so you need to have an understanding of the mechanics that actually happen. And you can see that on display here with the Metrics Master Income Trust. We can see during COVID, it went from $2 to what's that, $1.57, like very quickly. That was within the same month. But then within like a month, it's back up to $1.80.
And its NTA, I believe, from memory, was basically the same throughout. So the net tangible asset value of the underlying loans was like $2.06 the entire time. But the share price fell by, 30%?
Yeah.
For a period of time.
So this is the thing. If you know what you're doing, you can use these as an opportunity for yourself. So if you knew that the Metrics Master Income Trust, like all the loans that were inside it, were going to be fine at the time when you were buying, and you could have been like, oh, okay, it's falling, but I believe that the assets inside it are going to be okay, well, you could keep buying it. Yeah. It's kind of like probably the easiest way for people to understand what we're saying is to think about a real estate investment trust.
Yeah.
Something that we've spoken about for a long time is the Charter Whole Long WALE REIT. This particular REIT invests in all different types of things. We've had them on the show before, but it invests in real property, right? So
600-700 properties from memory.
Yeah. So you're going to get the moments where the share price is above the fair value of the properties, and sometimes when it's below. And you just kind of have to accept that fate as a REIT investor, real estate investment trust. The same thing applies for these other types of trusts. I think it's fair to say. So that's a good one. Maybe just parting words here, Drew. Do you use any listed investment trusts in your model portfolios?
No, we have in the past, but we're more where possible, and this is the benefit of a platform that we'd prefer to invest into because of that risk. The net tangible asset value differentiates from share price. We prefer to invest in the managed fund version because we know when we lodge that. I mean, we used to say lodge the paperwork to get our money back, but when we put a redemption request, and you're going to get the net tangible asset value at the end of the day that you lodge it, or in most cases, at a reasonable time.
Yeah.
That's our preference. That's what one of the benefits of platforms, that you don't have to do all the paperwork that would come along with doing that, and would make it incredibly difficult to invest that way. Yeah,
it's a little bit tricky, but thanks to the ASX, you can actually just go on and buy these things. But just be mindful of that thing is what I'd probably say. We've probably got time for 2 more questions here, Drew. It's a very busy week this week, so apologies for the slightly shorter episode this week. And dropped my DAX writes in and says, love the podcast and love Drew's jokes.
Sometimes I have to double up.
Next question. Have always heard that young people should not contribute too much to their super too early, as super is essentially locked up until age 60, and then there is always the unknown risk of future regulatory changes. They go on to say, but if a young person has a good income and is investing well in their own name, in what what sorts of circumstances do you think it would be worthwhile for a grandparent or parent to make a substantial contribution to a young person's super rather than gifting it in their own personal investment for their own personal investment, e.g., an amount of 2 or 3 years worth of non-concessional contributions to a person aged under 30? Given that super is the most tax-effective vehicle for wealth accumulation and that time is the most important factor in wealth accumulation, surely, I inserted that bit, it would
Surely.
be a huge benefit to build as large a super asset base as early as possible. So the question, if I may generalize, well, they've already generalized, is
Great jokes, basically, is what you're saying. Yeah. That's all I have.
great jokes. They've obviously lost their marbles completely. No, so Drew, do you think there's ever a time where instead of gifting someone money, or just in general, ever a time when you should invest, say in a 20-somethings, super for them?
This is the perfect it depends.
Oh, where's the hat, by
It
the way?
depends so much on the financial position of the the person, the recipient. And yes, it probably does make sense if they're in their incredibly strong position, got a good career, they've saved money, they're going to retire independently anyway. So this is going to be an added benefit to that. And then it depends on the financial position of the parent. So where there's significant wealth that they're not going to be able to spend or even put a dent into in terms of spending, we've helped many clients make multiple contributions on behalf of their children as a way of transferring wealth. But then I'm reading Die with Zero still. I got through the John Addis's book in a day. Die with Zero is taking a bit longer, so I'm not supposed to laugh as much when I make my own jokes. But Die with Zero, the idea there is that part of the idea, not the whole idea, is you can be more impactful with your children or the beneficiaries having access to that money now, and rather than having to wait until they're 67 or being able to enjoy it together. So it's very much financial position. If both parties are in a great financial position, sure, it makes sense. But I'd always be down to what's the most impactful outcome you can have for your family and your family group.
That's a good thing to say, Drew. And Drew's responding to a YouTube comment, by the way, that said Drew laughs at his jokes way too much.
You're not the only one that's told me, whoever that was. I'm told that regularly by friends, loved ones.
One of the things about
children
doing podcasts, and if they're podcasts and the videos and the events and everything gets successful, quote unquote, one of the beautiful things that comes with that is a very thick skin. But we have a chuckle at some of the digs every now and again, and that was a good one.
I'm still surprised people listen, so more than happy.
Anyway, I wouldn't do it. That's my answer to this question.
Well, you could spend that $100,000 on your boat, couldn't you? That's how expensive.
Mate, you'd probably get at least, I don't know, a new wheel for that.
Yeah.
That's about it. But boats and weddings, just never mention them because you'll pay 3 times as much. But seriously, I just wouldn't do it. Flat out wouldn't do it. I wouldn't put money into a 20-something-year-old super fund, particularly if they've got a good. Let's just say hypothetically, I knew someone in that situation. If they've got a good income, they're smart, they're young, they're investing well. No way. Just let them invest it, or just teach them to invest, or use it as a shared moment where maybe you have an investment company or a family trust that you have together, and you work together on that, and you use that as an opportunity to spend time together and discuss investments and go into business together and learn from each other and just connect. I think that's a way more meaningful thing than putting money into someone's super fund. And I actually think the idea that superannuation is the most tax-effective vehicle, I think that's actually a very simple understanding of how tax works in Australia.
Yeah.
I think that realistically, if you don't sell your investment and you don't have a lot of turnover in your portfolio, your tax rate can be incredibly low. And I think a lot of people miss that. Like, we had a conversation last week about investing for kids, like young kids, and everyone thinking about tax before they've even thought about what investments they're going to make is probably a mistake. And so Jamie talks about this a lot too, is that like one of the most important things you can give to your children is knowledge and wisdom. And another thing you can give them is time. And so I would use all of those things together. And rather than say, here you go, 20-something-year-old, by the way, you can't touch that money for 40 years. It's going to be great, but you can't touch it for 40 years. I think that's a mistake. If I was an older person in your scenario, Drew, like you were painting before, I would be inclined to gift the money or pop it into a family trust or something like this sooner rather than later.
Yeah.
Because I think with this massive intergenerational wealth transfer, I think the government's going to look at that as a huge opportunity to introduce new taxes and to introduce new things. Just maybe even if it's just like the UK's got. Why wouldn't they just do what the UK has already done? And I would think that that's coming in the next 10 years. And so I would be on the front foot with that as much as possible. It doesn't necessarily mean give them all your money. Just be really strategic about it.
Exactly. And I mean, good advice. Like what we talk about is about even if you have assets outside of superannuation, you've got plenty of time to get them in as you get closer to retirement.
Yeah, that's it. They could do it for the next 10 years and then chuck it into super. But the rules are going to change again and again and again as the government massages it towards a more, I guess, tax neutral position. Because ultimately what we've seen over the last 10 years is that the government has gone, all right, guys, you've done such a good job of putting that money into super. By the way, we're going to tax the heck out of you. Oh, you didn't really see that coming? Oh, that's too bad. But it's going to happen because too many of you have got too rich, and that wasn't the purpose of this tax law. So we're going to clamp down on that and bring everyone in line. We're going to get those outliers out of the system, and we just want everyone to pay their pound of flesh, regardless of whether they're in super or out of super. I think that's my rant for today. But I wouldn't do it. I would use it as a massive opportunity to share experiences over time with someone younger. But I think your impact statement's really important there, Drew. Okay. Final one for today. We'll be quick. Jesse the chemist, Cruz.
It's going to take longer to read out this question.
I know. I'm not going to read it all out. I'm going to ask you, would appreciate your understanding in your basic non-nonsense manner the workings of a covered call ETF strategy similar to JEPI, JEPQ, etc. These offer quite attractive yields when compared to high dividend-focused ETFs, but are nowhere near the total market returns when it comes to the broader market. So, Drew, covered call, what is it? What's the strategy? Tell me more.
So my understanding, and I'm not great at options, is a covered call is essentially you at options is a strategy where you own a portfolio of shares and you're selling call options that allow someone else to buy those shares off you at a certain price.
That's pretty bloody good.
And the price is higher than the current share price.
That's pretty darn good, man.
Yep. So essentially what you're doing here is selling a small portion of your shareholding, but doing it using options. That makes sense. And why do you sell options? Because when you sell an option, you get paid an option premium, and that option premium is income. So rather than having to sell your own shares, realize capital gains, you're actually turning this option income into taxable income as opposed to capital gains income.
Great summary.
Yeah.
Now we'll wrap it up with, like they told us in Year 10 English, we'll wrap it up with a little example here. I have $100 worth of shares and it's just sitting there. It's like in an index fund. And I say, I wonder if I could make more income from these shares. I know what I'll do. I'll promise Drew that if it reaches $120, I'll sell them to him. And you might be thinking, well, why would you make Drew that promise? Because I think from my situation, well, I could make $20. It could go from 100 to 120. And Drew says, yeah, sure, I'll buy those shares off you in the future. And what do I get for that? I get a little bit of income. I might get $1 or $2 in this example. And so I get 100 plus the money that Drew's given me. And Drew goes, yep, happy days. I'll take them off your hands. And the reason that people do this is because it gives people, options effectively. And the problem with this strategy is that if the market goes up really fast or just reasonably fast, doesn't have to be really fast, my shares get what we call called away.
Yeah.
The options contract becomes more valuable as it approaches $120. And Drew, in this instant, might sell that option, or he might say, hey, Owen, give me those shares because I think it's going to go over 120 and I want to get them now so I can sell them again for 130 in the future. And so ultimately, that's what we've seen over the past year is these strategies have way underperformed the broad market, because as we mentioned at the top of the show, the broad market's done exceptionally well. 30% in US, 20 in Australia.
And it's one of the most popular investments in America. I'm pretty sure is like the covered call over the S&P 500 is one of the biggest ETFs in the US.
Yeah.
But I think the challenge is it's great for flat markets. So you're going to get an income that's better than your standard dividend income, but your returns are going to be capped in terms of growth. So you're going to be middle of the road. You're never going to keep up with the market. That's not the intention of this strategy, but you're going to be converting more of that capital to income. So better suited to flat versus rising markets.
So when people say, hey, should I use a covered call strategy? I'm always like, maybe, but probably not. Because two reasons. One, it's going to cause a lot of costs and taxes. There's going to be a lot of frictional costs. So you're going to pay higher fees because it's a more complicated strategy. And secondly, the options constantly turning over mean that like options are typically like 3 months, let's say. And so you typically have a lot of turnover inside and a lot of tax crystallization, as Drew mentioned. And the second thing is in Australia, you get franking credits and you don't really have to do much and you get great income. That's why they're popular in the US, because you don't get that stuff. You don't get a lot of income and you don't get any franking credits. So that's where you see them used more.
We're more likely to try and manage cash flow by managing asset allocation.
Yeah.
So, selling a portion of each of different asset classes every quarter, every 6 months, so you've got more than enough cash to fund your income rather than relying on a product to do that for us.
Yeah, definitely. I really like that education you gave us there, Drew, on covered calls.
Didn't even prepare for that one. So,
well, you could do another thing. You could say, well, you can do naked call options.
No, we're not superhero. No, sorry, not superhero. What was the US one?
Robinhood, are you talking about?
Robinhood, yeah.
Yeah, so you can do naked call options, which is where you don't actually own the shares at all and you just write the options, which is a whole nother thing for another day. Don't ask me why they call them naked, but I think it has something to do with them being...
I've got a cracking dad joke for you today too.
All right, give us your dad joke.
You should do the name first.
Okay, name of the week. I don't understand the reference to Jesse the Chemist Cruise, but I feel like if I was a betting man, is that Breaking Bad?
Jesse,
yeah, Breaking Bad.
Cruise, is it?
Breaking Bad. I love that franchise, but they're all really good names. Even Slow Steady, you asked about Revasum, Rask 182. There was another one that we didn't read out, Get on the Good Gear. Don't know what that's about. Drop My Dax.
Got to be Jesse Cruise.
Jesse the Chemist Cruise, yeah, I love it. I did like Drop My Dax though. So right into it. Drop My Dax. Very Australian of you. It's the Australian Investors Podcast. You can write into us via the link that's in your podcast player. It says ask a question, or if you're on the Rask website, it's in the new menu, I believe. Just ask a question, send it in to us. We'd love to hear from you. And don't forget, Drew and I have just put ourselves on the spot for next year. Doing this 10K portfolio. I'm going to up the stakes. I'm going to see if I can up the stakes on you. I'm just going to go home. I'll go home and check some things first. But
I'm going on Reddit. I'm going to get all my good ideas off Reddit.
The Reddit.
Go find Roaring Kitty.
But thanks for today, Drew. If you want financial advice, you can head to the link in your podcast player that says financial advice or financial planning. You get matched with a financial planner. Once again, don't trust anyone ever until you've verified them on the moneysmart.gov.au register. You can put in someone's name, like say Drew here, and check to make sure that he does in fact operate legally under an Australian financial services license. Drew, you do have to give us your dad joke for today. Last week's the second one was very good. We got some good feedback about that.
And yeah, send questions and also send comments. We love comments.
Send dad jokes, send comments, send help.
Right.
Go for it, mate.
I haven't been to the gym in so long, I've gone back to calling it James.
It's not bad. It's not bad. I know. I have it on good authority that you do go to the gym. You play a bit of basketball every now and again.
Do my best. You got a couple of photos of that too.
Yeah, I did get a couple of photos, a couple of cheeky snaps. But this is heaps of fun. Someone did write into us and say that they loved our chemistry on the show. So I hope so. We haven't really thought about it like that, but there is a bit of chemistry going on here, and we do love what we do. So thank you to everyone for listening and supporting us. Send us your questions. Get in contact if you need anything. And if you did write in the questions there today, send Drew or I a message via the Rask websites to get your copy of The Golden Years, now available on YouTube. Drew, as always, thanks for joining me.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.